Joined today by Ben Johnson. He's the Director of Global ETF Research at Morningstar. Dave Nadig is the Managing Director of ETF.com. Let's start with the markets because despite today's sell-off, stocks are still on track for the best start to a year in decades. And investors are beginning to chase that particular rally. Here's the flow down. In January, U.S. equities saw $25 billion in outflows. But in February, we had $13 billion in inflows. Other areas of the market that saw notable flows were emerging markets and low volatility ETFs. That's curious. So what does all this mean for the rally, and what should investors be watching in March? Dave, we've talked about this for years. Are these fund flows on a monthly basis predictive of anything? Can we make any overall conclusions?
I sort of see them as a secondary investor sentiment indicator, right? And so when we see people coming back into U.S. equities after taking a breather, that to me means you can see a broad level of sort of appetite for risk again. And really that's what we're seeing across the board, even in things like fixed income. The things we've picked up have been high yield, longer duration fixed income. So I see this really as a sentiment indicator. I think it's very dangerous to use it as a trading signal.
I think you're right. But Ben, I would note here, it's not just U.S. equities that saw significant inflows. Emerging markets saw significant inflows as well. Can we make any conclusion here? Is risk appetite for overseas investing returning?
Yeah, if you're to look at flows, as Dave indicated, as sort of a sentiment indicator, certainly seeing large flows into U.S. stocks, emerging market stocks, long-dated treasuries would seem to indicate that investors' risk appetite improved in February. That said, it's difficult to divine anything from what goes on a month-to-month basis in terms of flows, because ETFs are used by so many different types of investors. They're used in so many different ways that there's a lot of layers to these monthly flow stories that you have to really peel back to try to understand what's truly going on.
That's a very good point. We've often noted that ETFs are not just done by buy and hold investors. They're used as a tactical allocation, so people will come in, active traders will come in and out of that, and you've got to be careful about making any conclusions.
Yeah, and I think we saw that in some of the flows that we've seen. Some of the more traded products, when I see a big flow there, I think, this is traders getting back in. So for instance, like MBB, which is a mortgage-backed securities ETF, that's used by traders predominantly to really get quick exposure to that core section of the market.
What do you make of the fact that low volatility suddenly has had a lot of inflows? Now, low volatility are companies that are defensive. Generally, they pay high dividends, so you get pharmaceutical stocks, you get Pepsi, Johnson & Johnson, you get McDonald's, kind of things like that. Are investors a little worried about the speed of the rally?
For sure. I mean, when I see money flow into things like USMV, which is the US Minvol Fund, right, I think that investors are looking to get risk on, but they're looking to be a little cautious. So they're pulling money out of true safety assets like short-term bonds, but they're being a little cautious about their equity exposure.
And Ben, based on what you've been seeing in flows so far this year, what's your thoughts on March? Do you think we're going to continue to see some money into the more defensive names, or do we see any sign of significant breakouts? What about, for example, European equities? We've been waiting for a long time for Europe to bottom. That's sort of the next bull argument, even though the data doesn't support it. What are you seeing right now?
Yeah, difficult to say, but I think to keep on the thread of low vol flows in particular, I think what many investors are seeing is that might be a perfectly acceptable substitute for active equity portfolios. If you think about sort of the calling card of a lot of active stock pickers for years, it's been, hey, we're going to take out some of the sting out of the downside. And what you've seen is that a lot of these low vol strategies, which for all intents and purposes are active strategies, have done exactly that, and done so pretty reliably based on a small sample of drawdowns in the market that we've seen. So I think people want to maintain that equity exposure, but do so in a way that's going to kind of take that sting out of the downdraft that will hopefully keep them invested come the next bear market. So I think that actually explains, at least amongst the buy and hold crowd, a lot of the flows we've seen into low vol strategies.